Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. And today I'm joined with Blake Christian. How you doing today, Blake?
Doing great. Thanks for having me.
Awesome. Awesome. Well, I'm glad to have you in the show. We're talking about a topic that we haven't talked about in a while. It's one of my favorite topics, so it'll be a lot of fun. So, Blake, tell us a little bit about your background.
And so I've been a CPA for 44 years, started my career at KPMG in Los Angeles. Currently, I'm a tax partner with a top 30 CPA firm, Holthouse, Carlin and Van Trite, and I work out primarily out of the Park City and Salt Lake City offices, but also spend some time out of our Long Beach office, which I founded, 30 years ago.
Okay. Nice. Nice. So what have you been doing lately?
Just, about 80% of my time now is spent on opportunity zone funds. So we have over 200 that we've formed and help our clients manage, and have several $100 million at in various real estate. And one of the unique things with us in the Oz space is we, probably about 25% of our businesses are operating businesses. And that right now I'm actually working on a large oil and gas project that's going to be all opportunity zone sitist. So it's quite interesting project.
Nice. So what size the opportunity zones are you working with? You working with like individual properties? You working with institutions, or like where's your bailiwick?
Yeah, what I describe it as, we deal with captive opportunity zone funds. So high net worth individuals sell their business, which is the most common, or they exit a large real estate project, and they usually have somewhere between $5 and $100 million of gain, and then we invest all or a portion of that into their own personal laws fund, and then they go off and do their next real estate project and or operating business for our serial entrepreneurs.
So tell us, for listeners who aren't familiar with the Opportunity Zone Fund, give us kind of a high level of what that's all about.
Right. So it's probably the most flexible tax program that I've dealt with in my 4+ decades. And so basically, almost any capital gain you generate, either long term or short term, it could be a real estate sale, sale of a business, sale of your personal residence over the $500,000 limit, Bitcoin, stock market gains, anything, pretty much anything. You within 180 days, you can roll that in, similar to a 1031. You can roll that in to an Oz fund, Opportunity Zone Fund. And what that does, first off, is it defers you reporting that gain, if you follow the rules, until 12/31/2026. And then you pay the tax in April of 2027 in most cases. And then if you hold the investment for 10 years and follow all the rules, your appreciation, let's say you rolled $1 million and it appreciated, your new real estate investment, appreciated to 10 million for as an extreme, that $9 million of appreciation plus all the depreciation you claimed in that interim 10-year period escapes federal taxation completely, and escapes most state taxation also, because most states have conformed. There's about 6 states that don't conform, California and New York most notably. But it's a very, very powerful program.
Interesting. Yeah. What are the other states that haven't conformed? The other four, do you know?
That would be Arkansas, North Carolina, Massachusetts, except for corporations, and then Oregon's kind of, they're kind of backing off the program a little bit too.
Feel so fortunate to live in Massachusetts right now. Thanks, Blake.
Sorry.
um, Interesting. So, all right, so you can defer taxes for basically another 2 years, and the gains you get from the investment are tax free. I mean, that's a pretty good deal. Why? But if you're only deferring for 2 years, I mean, I know initially it was like a 6 or 7 year stint when it came out. Are they going to update any of these numbers? Because I've heard that they're going to update it so you can roll it further into the future.
Yes, excellent point. And there is legislation that passed last year. Well, I'm sorry, it hasn't passed, but it's in Congress. It is very bipartisan. Had an equal number of Democrats and Republican sponsors in both the House and the Senate, and most of the same group that supported the program originally. And what that would do is it would push out the deferral period until December 31st, 2028. So we'd get another um, a couple of years deferral. And then it also would bring back the basis adjustments, which are really the smallest part of the benefit. But that you could get originally you could get a 5, 10, or 15% basis bump that would escape taxation completely when you recognize the gain. They're going to bring back under the proposal the 5 and 10%, depending on how long you hold that investment before the recognition date in 2028. So we're
Nice.
still hopeful it'll pass, but with Congress so dysfunctional right now, it just hasn't gone through.
What do you mean right now? They're always dysfunctional.
Continuing to be.
Yeah, yeah. I don't know how they can't pass a bipartisan bill, but
Yeah.
um,
And again, what I didn't point out, I'm sorry, is there's uh, you know over 8,000 census tracts that you need to invest in either your operating business or the real estate in order to get these benefits. So it helps the underserved communities. All these are have uh, high levels of unemployment, um, uh, you know, welfare recipients, etc. So it's a very well intentioned, and that's why both sides of the aisle support it. Is it it's helps these neighborhoods that have been ignored for decades, and we're absolutely seeing people make investments, our clients included, into neighborhoods that they would never go into, but because of the compelling tax benefits, they're much more open to taking the risk of investing in those communities.
yeah, no, I mean, I love this program. I love the fact it's bipartisan. Nobody can really say it's a bad deal if both parties agree, although that's not always a good indicator. But I've certainly liked this. So you mentioned you can put pretty much anything in there for capital gain, even home residence, which is interesting. I didn't realize that.
Well, yeah, we've got a lot of clients that have $10 million home gains in California, and it's a great safety valve for that.
So what happens with I know initially this was ambiguous. I'm sure it's been cleared up. But what happens with like estates? So let's say you're pushing this out into, 2026, and then next year you keel over and die. Does the basis get stepped up, or what happens there?
Excellent point. And I always pointed out to clients that there's a couple of negatives, and that's one of them. If you did a 1031, and so I always tell people if the taxpayer is old or in poor health or both, maybe the Oz isn't perfect because their heirs would have to hold it for the full 10 years to get the benefit. There's no step up at the date of death under the Oz program where there would be under a 1031, or if they just held the original asset. So that's one of the negatives. But again, the heirs could hold it and meet that 10-year mark.
I mean, it seems to me, I mean, obviously it depends on the person's situation, but Seems to me like a 1031 exchange for real estate investors is the better path than the Opportunity Zone Fund, unless, of course, the Opportunity Zone Fund is investing in real estate, which is going to be tax free. But
Right,
uh,
right. Yeah, and so I have this discussion all the time. And 10, what I always start off with a 1031 because you have 100% control for the most part as to when you ultimately recognize that gain. The day of reckoning right now is 12/31/2026. You're not going to change that unless legislation comes through. But if you do, the the negative on the 1031 is, unless you die, you're going to have to pay tax on the disposition of that property at some point. And what a lot of people, there's very little discussion about this point, and it really increases your return on investment is in the Oz program, all the depreciation you claim, including cost seg and everything in the interim period, that never gets recaptured when you dispose of it, in addition to the appreciation. And so that ends up, kicking your ROI another 2 or 3% per year, even even if you didn't have appreciation on the property. So you can really make a pretty strong case if you're going to keep it invested in real estate. And the other thing is you can do a ground up build. You have time to do a ground up build in a Oz fund, whereas you can't do that in a 1031. You have to really do pretty much completed property for completed property, um, for a 1031 to really work well.
Interesting. So, you know, I know once this kind of came out, all of a sudden real estate shot up in the Opportunity Zone Fund areas. Has that abated, or do you think the new bill is going to expand on the Opportunity Zone areas, or, how does that look? Because I mean, I imagine people just buy the land and just sit on it.
Yeah, yeah, we call that land banking, and that was frowned upon under the program. But we absolutely, saw huge increases in value immediately, probably for 2 or 3 years, and then the owners realized, hey, there's a lot of opportunity zone census tracts. They're not the only game in town. California has over 800. They have about 10% of the Oz locations, and now there's really not much of a premium that you're seeing in the marketplace for Oz properties. That there's some people that still hold out, but it's kind of abated, as you said.
So let me ask you this, because I believe when the rules came out, a lot of funds, quote unquote, funds were created to do Opportunity Zone funds, and they're usually fixed time period of whatever, 10, 15 years. I guess you have to wait 10 years, but there's limited time period. But isn't the benefit of this is that you never have to pay tax on the gain? So why would you ever sell it?
Yeah, excellent point. And yeah, our wealthy families and the funds that are family office type funds, that's absolutely from the get-go. They were, hey, we want to hold this. The program really runs through 2045 right now, and that's part of the discussion too. Is why should they even limit it to that? But yeah, since you're better off holding this, let it keep appreciating, and take advantage. So we don't have a whole lot of people that are planning on selling 10 years to the day. They're gonna kind of play it by ear and write it up as far as they can go.
So what happens in 2045?
2045, for whatever reason, they said that the kind of the program totally ends, and so in theory, if you sold the underlying asset after that point in time, you wouldn't get tax-free gains, but there's really doesn't seem to be any real policy reason to do that. But that's where we are right now.
So would the basis basically be stepped up as to that date? Is that how it would
Right,
work?
right.
Okay. Cool. So what are some of the challenges with opportunity zones that you've seen for people wanting to invest in them?
Well, we spend about 25% of our time fixing broken Oz funds. And so, you know, a lot of real estate developers kind of still that they think they can contribute property they own that's sitting in the Oz fund into an Oz structure, and that will work. And it typically doesn't. While you can make a property contribution to the Opportunity Zone Fund, what we call the Qualified Opportunity Fund, the QOF, you only get a deduction or a deferral to the extent you have basis in that. So it doesn't work work very well when you have low basis land and then contribute it to the Oz Fund, and it doesn't work at all if you contribute it to the subsidiary level. We'll get into the structuring, but it doesn't work at all. And so we have a lot of situations where we come in after it's already been formed and figure out that, it's just not even structured properly. And then there's also, there's timelines. You have to double the basis of the building part of the project because they want you to rehab. They don't want you to just buy a dilapidated building and then sit on it for 10 years and get appreciation. They want you to do a total rehab on it. So you have to double the basis in whatever you allocate to the building portion. You don't have to double the basis in the land. And that you have to do those improvements within a 30-month period. Now, I just had a call 2 weeks ago where a guy was in a panic and say, hey, our 30 months is running out in June. We're not going to make it. And I started talking to him. The project was up in Alaska, and they haven't even got their zoning approval. And you basically get to pick the 30-month period that the clock starts ticking. So there was, after we had a meeting, there was no real panic there. So there's a lot of complications. They're all manageable, but if you don't know the rules, you can have a lot of foot faults in the Oz world. And the other thing that we see very often is they didn't make the proper election to be an Oz fund. Most of these entities are just simple LLC partnerships, but you have to make an election on your first year return to be an Oz fund to start the clock ticking and get your initial deferral. And, there's been hundreds of people that didn't check the right box. And then you end up having to do a private letter ruling, which costs about, 25,000-30,000 of IRS fees and CPA and attorney fees.
Okay. Well, that's an expensive fix.
Yeah. Yeah. Yeah.
Now I understand that the opportunity zones qualify, businesses qualify as well. Is that correct?
Yes.
Not just
Yes.
real estate.
And that's kind of the most fun part of the program for me. So we have a lot of serial entrepreneurs, tech, people, engineers, et cetera, that are seeing the benefits and rolling it into an Oz fund, and then starting one or multiple businesses under there. And a lot of them are using a combination of, they might have a real estate entity underneath there as well as an operating business. And the other thing that we have kind of done from the start, our firm, is you're probably familiar with Section 1202 qualified small business stock. And so our clients that, once they get through the startup loss period, will convert that, LLC partnership into a corporation, C Corp, And then that starts a 5-year clock ticking for 1202 purposes. And so you could actually exit in 5 years and get up to, a $10 million per investor gain, or 10 times your tax basis in that investment, and exit in 5 years, and not even wait the full 10-year period. So there's a whole lot of ways that you can combine code sections and get a lot of flexibility and a lot of tax-free gains.
So if I understand you correctly, say I'm selling some asset, right? And it's a $10 million gain, and I roll that 10 million into a business, opportunity zone business, and then convert that into a C corp, and then 5 years later I can pretty much get that 10 million or more tax free.
Well, yeah, in that case, because it's the greater of 10 million per investor, or 10 times your basis, so you could have $100 million exclusion after only 5 years. And then
Wow.
and then you also have the luxury, if it ended up being $1 billion company, you just wait it out for 10 years, let somebody buy 51%, and then hold the rest to the 10-year period.
That's pretty cool from a planning perspective.
Yeah.
Now, is the opportunity zone investment, is that based on the so let's say I bought an investment for $1 million and it turns into $1.5 million. Is the qualifying amount, do I put $500,000 into the opportunity zone fund, or do I have to put, like the 1031, you have to put like all of the investment into the opportunity zone fund?
Yeah, and that's the beauty, and I should have made that point when we were talking 1031 versus Oz, is if you only have to roll the gain into the Oz fund to defer 100% of the gain. So if you had a $300,000 basis in a piece of, let's call it land, and you sold it for $1 million, to get the deferral under 1031, you have to buy $1 million plus piece of property to defer that gain. In the Oz world, you only have to reinvest 700,000, and you've eliminated 100% of your gain, and you walk with 300,000 cash and do whatever you want with it. So your basis doesn't have to be invested like it does into a 1031.
But what if you wanted to put more? So what if I wanted to put in, let's say I had $100,000 gain, but I want to put $1 million in. Does the full $1 million qualify as the tax-free gain if I hold it for more than 10 years?
No. And we tried to get, Congress, as they were revising this, to say, why not let people put non-deferred gain in also, where you're still doing things in underserved communities? Why don't you attract those dollars too? But they're limiting it to just the gains. But that was a very common question. And actually, when the code section's only about 4 pages long, so section 1400Z is pretty easy, but the regulations are, the multiple sets of regulations is about 800 pages. And the first time I read it a bunch of times, and I kept going back to people that were involved in the legislation. I said, I don't read it that you can't put other dollars in there. And they said, no, it's not going to happen. But
that's too bad.
Yeah.
Well, cool. So let me ask you this, because you'd mentioned before the show you do a few things. You do 1031s, which we had a person come on recently talk about that. What are some other interesting tax structures that people use for tax benefits?
Yeah, just if you don't want the complexity of the Oz funds, and I'm not going to sugarcoat it and say they're easy, but they are super flexible, as you've heard. So, the most basic is just you do an installment sale. So you sell, again, your land with a building on it, and you do an installment sale. You take back a seller note for a part of it. Now, what a lot of people don't understand is the even if you don't collect a dollar on that note in the year of sale, you still the depreciation recapture that you have on the depreciation that you've claimed in the past is still recaptured day one, even if you don't collect anything. So you got to watch that. You got to make sure you collect enough to pay the tax on the depreciation recapture. Um, but those are very easy. Some they help get the price that you want, because you're helping them finance, especially in this market. It's hard for people to get loans, and worst case, they don't make the payments, you repossess the property. So it's not a bad way to go. The risks of it are that the good news is you defer the gain until the cash is collected. Your tax basis is allocated to kind of each tranche of collections that you get also, but you do run the risk that capital gain rates could be higher, and that's also a risk in the Oz world. We don't know what the December 2026 tax rates are going to be. We don't think they're going to increase, but they could. It's only a deferral of the gain, not a deferral of the tax payment. So that's and then installment sales don't apply. They apply to real estate. They could apply to a business sale, but they don't apply to inventory sales, and they don't apply to marketable securities, stocks, bonds, that type of thing. So, but they're easy to do. They're routine, and you can get a nice interest rate while you're financing that property on behalf of the buyer. And then so that's one we use routinely. We've already talked about 1031s, and again, especially when I'm talking to California, and a lot of my clients are still in California, we always start with a 1031 over an Oz, because you're also deferring the California tax. Since they don't recognize the Oz program, we still have to pay all the California tax on an Oz deal. Whereas a 1031, we can kick the can down the road along with the federal tax.
So this brings up a question here for some of this tax deferral. I know with opportunity zones, things like installment sales, I guess 1031s kind of fall in that bucket. But so what happens? California is a good case study because everyone's leaving California because it's a mess. So what happens if you settle this up? You're in California, whether it's an opportunity zone, or whether it's an installment sale or whatever, and then you leave the state, and then let's say the installment sale, you have it pay 5 years later, and you leave the state and you move to Nevada where there's no tax, and then when you're there, you accept the funds there. How does all that work between states nowadays?
Yeah, California is very aggressive. They're going to still treat that. I mean, it's still if that was a California situs real estate project that you sold, it's still California sourced income, even though you deferred the gain. So they're gonna chase you on that. 1031s, and a lot of other states have followed suit, but I don't know, for the last 7-8 years, maybe longer, when you do a 1031 in California, you are required every year to report, even if you're not a California resident anymore, and verify that you have not sold the replacement property. And when you flip that replacement property, even if it's 20 years from now, they're going to come after you for their portion of that tax you deferred. And
So do you have to pay it in two states? Like I moved from California to Massachusetts. Massachusetts doesn't have, any sort of preferential tax treatment, so I have to pay it in both states?
um, a, yes, but there in your state of residence, usually you get a state tax credit for the tax that you paid in the other state, but only up to, California would have a higher rate, I believe, than Massachusetts. You only get a uh, they only give you a credit up to the maximum that you paid in Massachusetts. So you could still be out of pocket, you know, the incremental tax that you paid in California. But most states have a mechanism to give you a state tax credit, so you don't have double taxation. But if sometimes under weird fact patterns, you can get double taxed.
Well, that sounds horrible. Who wants to live in
Yeah.
California these days?
I left 11 years ago.
Yeah, well, I can appreciate
It was
that.
a great place to grow up, though.
Yeah, good timing on that before all the craziness started.
Right.
Um, so what about places like Puerto Rico that are, I mean, tax havens nowadays? People are moving there and um, like opportunity zones and stuff like that. I mean, what if a state's not as aggressive as California because they're kind of unique, but not all states are like that.
Yeah. So Puerto Rico is interesting. 98% of the island is opportunity zone, and so we had. I can't tell you how many conversations I've had with business owners and things that not only wanted to do Oz in Puerto Rico, but also change their residency, which is a little easier because it's um, um, a U.S. territory. But there was a whole lot of buzz on Puerto Rico in the beginning. Now Guam is another territory that is eligible for Oz, um, but they it kind of lost its luster, a couple of years in. But I haven't had any clients make the jump, but I other people in the Oz world that I deal with have had a number of clients do investments there as well as change their residency. But it it there was a lot of buzz and then it kind of went dead. And they also kind of the locals there. There was some backlash because you had all these Americans coming in there and doing speculative land deals and things, and there was some backlash on that.
But what about I guess my question is more so California real estate, I got it. But what if you live in California or just take a maybe even a non-aggressive state? Let's say you own securities. Let's say you owned like the S&P 500 index and you've got 10 million in capital gains on it. And then you've been sitting on it for years and you move to Puerto Rico or somewhere else and then you sell it there. Whether it's you just sell it there, whether you do an opportunity zone fund on top of it. Are states like California going to chase you, even if it's something that's a little bit more uh, maybe not as concrete as like securities?
No. In your example there, as long as you didn't trigger the gain while you were a California resident, then they tax you in your state of residence or domicile. There's two different tests. And so there you would escape whether you moved to Nevada or Puerto Rico. California wouldn't have a bite on that.
Okay, so
When
it's
you get
really
into
more for
some
real estate.
Yeah, when you get into some weird things though, is if you had, and we have this a lot, let's say you have a tech executive and they've got vested stock options that, are in the money at the time they left California. That piece of it is still California sourced income, even though they exercise those after they move to another state.
Okay,
You,
so
you
there
have
are
to watch.
some things that California will kind of have a reach on.
Right. And that's the other reason, because California and New York don't recognize the Oz program, again, if I have serial entrepreneurs, I say, look, because a lot of them are looking at leaving those high tax states as they get closer to retirement. So I say, hey, let's think about doing an operating business rather than a real estate investment, because yeah, again, you could move to Nevada, and if you did an Oz investment and reinvested in California, doesn't matter that you're a Nevada resident. It's California sourced. They're still going to take money out of that. But if it was an operating business, and maybe it started in California, but you move it to another state, um, that has no tax, or a lower tax, and then when you exit, um, then it's going to be taxed at your state of residency, not where you started the business. You can at least
Okay.
move it.
So some of these larger companies are moving to Texas from California. They're able to escape the California tax because of that. So
Right,
they're just
right.
moving the business. Okay, that's interesting. What and I'm not in California, but what are some ways that people can, outside of that, that sounds like a great way. Are there other ways that people can come up with ways to either move or shelter their capital gains?
Well, the other one that comes up is the Delaware Statutory Trust, and that is what I kind of refer to as like a prepackaged 1031. And so there's a lot of firms out there that that will take they'll essentially be your accommodator, and let you buy a fractional interest in you know it could be residential, it could be commercial building, and then they professionally manage it. You don't have all the headaches of doing a traditional 1031, and then you have to manage the property and things. So there's a little more cost associated with it because there's professional management, but it's easier to diversify. You can do these deals in 3 to 5 days instead of doing a big search for a bunch of properties, and they've got a bunch of properties in inventory. So that and then again, you decide when you sell it. You don't have the burden like an Oz fund where you have to pay the tax in 2027. The bad news is this is on the IRS target list, what we call the dirty dozen, and the IRS isn't real keen on these. And there's different shades of gray on. I'm not saying all. There's some very reputable Delaware statutory trust firms that follow all the rules, but there are some that are more aggressive. But it's if you do one of these, your likelihood of audit's probably a bit higher, or a lot higher, I would say.
So why are those? I mean, I understand why are those in the dirty dozen? I mean, it's 1031s are very commonplace. So why is the DST on their dirty dozen list?
I just think there's some bad actors in that space, and that have skirt the rules a little bit, or a lot, and so it's just again, we don't I don't start there, but it's usually as we're talking through 1030, traditional 1031s, Oz deferrals, probably 10 or 15% of the time DSTs come up, and and we'll take a look at what they bring to us, but we don't push those as a great solution.
Yeah, no, that definitely makes sense. So, all right, as we kind of wrap it up here, what are some final thoughts you can leave our listeners with? Some practical takeaways that they can use today.
I think you know I like choices. I like multiple choice. I think my clients like multiple choice. And even though I do focus a lot of my time in the Oz world, I don't try and put a square peg in a round hole. I ask a lot of questions. Sometimes Oz makes sense, sometimes it doesn't. But it's definitely should be on your short list if you've got gains of $1 million or more. And if you're a serial entrepreneur, you could have a gain. We've done gains as low as 25,000 that you can leverage into an operating business and start the clock running on tax-free gains in 10 years. Again, you take a tech company, biotech, some inventor, and that, some small investment, you could leverage it with debt, and you could grow that into some massive business with the right idea or the right software, and end up with tens of millions, if not more, tax-free gains in the end.
So it's
But go
so
ahead.
just to
I'm
be
sorry.
clear, so for a business, it's not the revenue, it's the gains that you're getting the
Right,
benefit from. Yeah, okay.
right. And but you know, in the tax world, that's get different opinions, uh, but scour the the landscape, and do some of your own research too. But there's a lot of solutions out there, and I just find that a lot of people, including CPAs, tax attorneys, they just they're kind of hell bent on their one or two ideas, and they're not always broad minded. The biggest problem we had at the start of this program, the biggest hindrance for people to move forward with Oz investing was the CPA community, because a lot of CPAs didn't understand the program, and I'm guilty of it occasionally too. Is if you don't understand something, you just tell a client, no, that's not a good idea. And we had a lot of resistance. And now, probably 20% of the client work we do, we're working hand in hand with their CPAs, and we're just being the sounding board and the technical resource on the Oz part of their structure. And so anyway, that was a kind of an interesting thing for the first couple of years, all the resistance we got from other CPAs.
Okay, awesome. Well, Blake, I really appreciate you coming to the show and sharing your wisdom. I love this sort of stuff. This is, secrets of the wealthy right here that people love to understand, and how they can actually apply this in their own lives. Where can people find more about you?
Yeah, so I mean, the easiest that you can get me on the web, our firm initials, WWHCBT, Holthouse Carlin Van Trite is the easiest way, or you can just Google Blake Christian CPA, and you'll find I have a lot of articles and things on the web. So
Awesome. All right. Well, thanks again for joining us, Blake. And yeah, we'll have you back in the future. I mean, this is great stuff.
thank you, Kirk. I appreciate it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist, because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Blake. Really appreciated him coming on the show. It's always interesting to hear different tax strategies and what some of the wealthy are doing to save on taxes. Now we're into the panel portion of the show where we have our very own Barb Friedberg. Hey, Barb.
Hi, everybody. Happy to be here.
Great to have you. And we also have our own Phil Weiss. Hey, Phil.
Hey, Kirk. I'm also happy to be here. Good to see you.
Yeah, great to see you too. Well, this will be a fun show. So, Barb, what were some of your takeaways from the interview with Blake?
I have been fascinated with opportunity zones for a really long time, and some of my feelings still hold, which is they seem kind of complicated to me. But the one thing that came out that really impressed me, particularly because I live in California and have experienced a fair amount of appreciation on the home we bought in 2011, is that opportunity zone strategies are not only for the very wealthy, but if you have big capital gains on your own property, you might benefit from investing in an opportunity zone, particularly if you can let those capital gains reinvest them in an opportunity zone property and then just let it go for years and years if you're not going to need that money. And ultimately, it will end up saving you some money on taxes.
Yeah, totally agree. Phil, what are some of your thoughts?
Opportunity zones are an interesting option as a way to minimize your tax costs. I'm always a fan of ways that we can legally lower our tax bill. I mean, to me, we want to think about taxes from a lifetime perspective and not just in any one year. And the ability to roll capital gains into something else where you can then avoid paying taxes on them is never a bad thing to me.
Yeah, agreed. So, let's dive in a little bit because opportunity zones I've found fascinating. When they first came out, every Tom, Dick, and Harry in Wall Street was selling a fund, an opportunity zone fund. As Wall Street typically does. If there's money to be made, they'll come up with a product. Whether it's good or not, totally different question. But they love filling the gap. It was ESG. And then it was opportunity zones. Like every time they come up with something, which is both good and bad. It's good because they're coming up with products. It's bad because a lot of times the products are crap. But I think it's important to note that this is a really interesting space, and it does have bipartisan support, and not many things do, which should tell you something about this, because there are people who think, oh, this is a bad program. It's taking advantage of the poor. Well, whether it is or not, it has bipartisan support. So this is not a partisan issue, right? I know we like to make everything partisan, but it's really not a partisan issue because both sides agree that this is I guess, duly agreed upon strategy. Now, the question really is how can you take a part of this? So there's a few ways, but Barb, is this something that the average investor should be looking at, or how should people be thinking about this? Tax strategy of the rich.
Maybe they should, because the average person, for example, maybe you've built up a really nice business. You're someone not fancy or anything, but you've built up a decent business. Well, then you sell it, you have an exit, and you have a lot of capital gains. In that situation, you might want to look at an opportunity zone investment. Or, as I mentioned in the intro, If you have bought your house a long time ago, you live in a state where you're going to end up owing taxes on capital gains for that house, and you don't expect to need the money from the opportunity zone investment for a while, then you might also want to consider those type of investments. And I'm going to turn it over to Phil because he's the tax guy. So I'm sure you can elaborate more on the specifics of situations where I think they may be viable. You may not see it today, but you might want to have this investment in the back of your mind. So Phil, thoughts?
So if I think about capital gains tax, I mean, I will say that they are lower than ordinary taxes. So if I'm thinking of a priority in terms of what taxes I'm trying to reduce, my capital gains might not be at the top of the list, but it doesn't mean that I don't want to limit them. I mean, I'm all about paying the least amount of taxes that we can over our lifetime. So whatever we can do to lower our tax rate, it's one strategy, but I think there's others that we have to consider too. Like to me, one of the most important ones, especially where we are today, is Roth conversions. So if we look at our current tax situation, the current tax law was passed at the end of 2017. It was expensive. The only way that it was able to be put in place, that the corporate part where they cut the corporate rates from 35 to 20, that was made permanent. But what they did to the individual tax system was only put in place for 8 years, because that was the only way with the balanced budget and all that, those other parts of the budget system, that's the only way they could get it through. So we have very historically low tax rates right now. You know, we have a 10% bracket, we have a 12% bracket, then we go to 22 and 24. And for a married couple, you have over $390,000 of income, taxable income. You're still taxed at a 24% rate. That's a historically low rate. This system goes away after 25. Will they continue it? Maybe. Will they not? Don't know. I mean, a lot of it depends upon the outcome of the election. A lot of it also, to think about all the money that we have a huge deficit. We spent a lot of money because of COVID and some other things that have happened. So what are the impact on all those things? It doesn't feel like tax rates are going to go down. They could go up. And when I look at taxes with clients, like I look at what their lifetime's going to be. And if you're going to be, and I compare it to what the old system is, because right now that's what we have. And that 24% tax bracket can become 28 or even 33 really easily. If we can do things that lock in that 24% tax rate, why wouldn't we do that? Sometimes it's lower, right? So I have some clients that their income's less, and so maybe we're only locking in a 12% rate. But we want to fill that up, fill up your low bracket, whatever bracket you're comfortable with. I call it bracket stuff, and you want to fill that up with income, take advantage of that low rate. And then I think about, like I mentioned, Roth conversions in this context, think about it in this way. I wrote a blog once called How Roth Conversions Can Benefit You, Your Surviving Spouse, and Your Heirs. And the reason I say that is that you're a married couple. I can fill that 24% bracket or 12 or whatever bracket works for you. Then one spouse typically outlives the other. And within a couple of years, that surviving spouse is going to be filing single. So now that in today's parlance, 390,000 becomes 195. And that's all that's there at the 24% bracket. But all the money, if you were diligent saver, all the money that was in those IRAs normally goes to your spouse. So they could, if you were in the, if you're getting 300 and something $1,000, they're still going to get close to that. They're going to lose a Social Security benefit, maybe lose a pension, but the other stuff stays there. And then, so doing those Roth conversions can benefit that surviving spouse. It can also help you manage your excess Medicare premiums, because you can keep your income to certain levels for, they call the income related monthly adjustment amount, or IRMA, on Medicare. And then when your IRA passes to your heirs, if they got a regular IRA money, they have 10 years to get it out, and they're going to pay tax on every dollar that they get out. And if they're working and have a good job, it's going to sit on top of their income, and the tax rate can get really high. And they're going to have to take it over that 10 years, and they don't really want to lay it all in at 1 year, because I could really bump up the tax rate. But if they get Roth money, they still have that 10 years, but they don't have to take it. They can let it sit there for 10 years and continue to grow tax-free for 10 years. and then pull it out, or they can pull it out as needed over that 10-year period, but they're not going to pay tax on that money. So those are strategies that really matter a lot. Those Roth conversions are really valuable. There's other things we can talk about too, but I like to focus on Roth conversions right now. That's something I'm talking to a lot of clients about right now, because I think it's really important that we remember that.
Yeah, no, that's great, Phil. I'm curious because, we're recording this a week prior, so things may happen with the political realm, obviously. But, based on what's happened prior to now on the 19th, it looks like we're going to have Donald Trump as the next president. But, who knows? We've still got a few months. But if that's the case, you could probably imagine what is going to happen with the tax code, based on what he said so far, which is, lowering the taxes. So, do these strategies still are they still important if you're paying lower taxes now? Because I mean, who knows what's going to happen? Obviously, Congress has to pass this, and he's directing traffic, but he's not passing bills. The Congress does that. But if they're going to pass lower taxes, or even retain lower taxes, which is, I think, part of the taxes. Some were permanent and some were temporary. Do strategies like this still make sense in pushing them till later, or does it make sense to do more of that now?
I still think they make sense. So if we think about a Roth conversion, if I convert, and I'm going to go back to using that 24% rate, if future tax rates are higher than 24%, the Roth conversion was definitely a winning strategy. If tax rates stay at 24%, you break even and don't worry about the fact you're paying taxes today versus in the future, because if you stayed invested the same way, you're going to get the exact same growth. So you're going to pay more in taxes because you're going to have a bigger gain, bigger distribution in the future because it grew in that IRA. The only way you lose is if that tax rate falls. But if you look at it from the perspective that I'm comfortable paying this rate of tax, then that's a risk that's willing to take. And then if I layer in those other two pieces, when you have a surviving spouse and their tax rate, their tax bracket gets cut in half, or you want to leave money to your heirs. Like I have families that they don't really want to spend their money in their IRAs. They want to leave it to their kids. Well, if their kid, like as I said, if their kids are working, pulling the money out of the IRA, it's going to sit on top of their other income. They only have 10 years to do it. So still, it can add to their tax bill. So I do think that it's still worth considering, even if the system stays the same. We don't know, like you said, Kirk, we don't know for sure what's going to happen. I go back to when I started my career, I worked for it's now the big four accounting firms. And every year when I worked in the tax department, they would talk about tax legislation. And all the big think tank guys in the firm would write, okay, here's what's going to happen, and here's what it means, and everything else. And then it wouldn't pass. So even when it's being discussed, like remember we had the whole thing a few years ago, there was going to be no more backdoor Roth IRAs, there were going to be no more Roth conversions, there were going to be all these limits. None of that stuff passed. So just because we have these things that are out there, it doesn't mean they're going to happen. So we don't know. So if I go back to the fact that we have historically low tax rates, I want to take advantage of them. I know that if rates go down, it could cost me a little bit, but people also forget that if you've been a really good saver in retirement, like I've done financial plans for people that have a couple $1 million going into retirement, and then they wait until 73 or some people 75 to start having to take money out. You wait that long, that money can build. And that 2 million, if we get 7% growth, 10 years, your portfolio doubles. Rule of 72 says you divide the growth rate into 72. That tells you how long it takes to double. $4 million from two, that becomes really big distributions. And over time, they can get really big. And you can end up in higher tax brackets in retirement than you were while you were working. So you want to think about all those things.
Yeah, I appreciate the mental models there, because I think it's important to understand taxes. Most people just think I'm going to push it off, and then they don't realize like they're 72 and they're like, oops, like now I got a big tax bill. I got to pay all this. And what it used to, and funny thing is, it used to be, we used to have the stretch IRA, right? You put something in, your kids stretch it out, for, assuming you're giving it to your kids, stretch it out for the remainder of their life. And now you don't have that anymore. Like that was a great planning tool, which has disappeared, unfortunately. And now you got to take it out, I think, within 10 years. And it's still something, but at some point someone's paying the nut for that. And that's, especially if you're giving to your kids and your kids are earning high income, then it's going to bump them up, and then it all just kind of rolls into one big ball of tax. So yeah, totally appreciate your perspective on that, Phil, with the tax planning. Barb, so opportunity zones obviously have to do with real estate. I know you're a seasoned real estate investor. Is this one of the best strategies people could use for real estate, or are there other things that people should be thinking about when they're investing in real estate for tax planning?
Well, there's also the 1031 exchange, which gives you a certain window of time when you have a certain property, you sell it. If you buy another property that I believe is similar within that same time period, then you can kind of roll over your capital gains. So that's another solution, and there are people to help you with that. Um, and that's another opportunity for real estate investors. But I also want to throw something else out that is in the tax realm that has been in my mind for decades, which is many of you work a W-2 job. You work, you get a W-2 income, and you really don't have a lot of play in what you do with your taxes, except for, like Phil said, maybe a Roth conversion. But if you have any kind of side business, then you can deduct in expenses off of that business, even part of your house payments if you're running the business out of your home. And so year in, year out, let's say you make 5,000, 10,000 in a side business. You don't have to make a lot of money. And those side businesses can run from anything, from running a website, from, hauling junk, from doing handyman or handy gal jobs for, through Thumbtack, or driving for Uber. You get to write off a lot of expenses that would not otherwise be tax deductible. And that is another way throughout your life that you can save money on taxes, and keep your tax bill lower. So I did just want to throw that out. Actually, my husband and I, we've been married over 40 years, and throughout our entire lives, we have had what is called Schedule C income, which is a side business. My husband has done consulting, and I've had my own side businesses over time, and that has saved us a lot of money on taxes. So I did want to throw that out as well.
Yeah, no, appreciate that, Barb. And the opportunity zone interesting with businesses as well. It's a little more complicated to deal with, but certainly the tax code around that's pretty interesting. So, we're gonna kind of wrap it up here on this episode. But Phil, final thoughts from you on this. I know you're the expert tax guy. What have we missed, and what should we be thinking about here to put it into practical use?
So 1031s or like-kind exchanges that Barb mentioned, those are also good tax planning strategies. They allow you to take one property that you have and exchange it for another property that's similar. I believe it's 6 months that you have to complete the exchange. There are parties that you can work with to help facilitate it, so you don't have to find somebody that wants your property directly. These accommodation parties will take it, and then you can get a replacement. Those are good tools. I also want to add something to what Barb said about having your own business. It's not just having the ability to deduct expenses is great, right? And like when you work for a company, the company deducts all those expenses. What they pay you is their expense, but you don't get any other expenses against it. But the other thing that people often forget about is that when you have a side business, you can also open up either a KEO or a solo 401k or a simple IRA or something like that. And you can take some or all, depending upon the fact and circumstances, of the net profit that you get from that business. And you can also save it for retirement. You can put it into the equivalent of your 401k or IRA, or you can, some cases you can use a Roth, but that's another way that you can also help save for retirement in a tax efficient manner when you have your own business. So you get, I was talking about this with one of my kids the other day. Like one of the advantages of my business is my wealth management business is my own business. And so I get those expenses. I say, here's some things that I do that if I was an employee, I wouldn't be able to deduct. But don't forget too, you also have tax advantage retirement savings. So there's lots of different levers that we can pull. We didn't talk at all about asset location, which is thinking about which assets belong in which type of account from a tax perspective because of how they're treated. But that's another thing you want to keep in mind. So when it comes to taxes and being tax efficient, there's lots of different levers that you can pull to try to lower your bill. Like I said, it's lowering your lifetime tax bill. Don't worry about a given year. Like some people go, oh, I didn't pay a lot of taxes this year, but that may not be great because you might pay a lot more in a future year because you got your bill down so low this year. So you want to think about all these different opportunities and what works the best for you. Opportunity zones is one, like-kind exchanges, Roth conversions, asset location. These are all things that can help.
Where can people find more about you, Phil?
So I know that experiencing big life transitions can be stressful. My job is to help women facing new beginnings be empowered with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you can download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook. And you can also sign up for our blog. Thanks for having me today. Appreciate the conversation.
Yeah, thanks for coming on, Phil. Barb, final thoughts from you.
I want to do something a little unusual in this segment. First of all, I want to call out my two colleagues, Kirk Chisholm and Phil Weiss. They both happen to be financial planners, and they're not really allowed to toot their own horns, but I would like to toot them on their behalf because they are both skilled in various aspects of financial planning. And I know Phil also has an amazing newsletter that he puts out regularly every week. So whether you hire one or both of them or none of them, I'd suggest you check out Phil's newsletter. Taxes are a reality. They are not pleasant to think about, to plan for, but you owe it to yourself to learn at least a little about them because they cost you so much money over your lifetime. In fact, today, as I am approaching my retirement, my husband's and my taxes are actually almost as much as all of our living expenses. So it's like kind of important. So you can find me, Barbara Friedberg Personal Finance, on my website and on my YouTube channel at Barbara Friedberg.
Thanks for coming on, Barb.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.